Welcome to the deep dive. So today we're tackling a big question, one that probably crosses everyone's mind, especially when things feel a bit uncertain economically.
Mhm.
How do you potentially take something like, say, $1,000 and turn it into a really significant sum, even if you're staring down, a recession?
Yeah, it's a pretty bold challenge, isn't it? Our mission today is really to unpack five distinct investment paths that our sources suggest could actually do well, maybe even thrive during a downturn.
Five paths, what are we talking about?
We're looking at index funds, for one. Then there's launching your own business, fine art, maybe a surprise there, individual stocks, and of course, cryptocurrency.
Interesting mix.
And importantly, the source material also dives into a sixth category, kind of as a contrast, which really highlights what not to do, perhaps.
Right. So think of this deep dive as like your shortcut to getting really well informed on a bunch of different strategies. We want to give you those aha moments,
Yeah.
some actionable insights.
Exactly. So you walk away feeling a bit more empowered, ready to make decisions no matter what the market's up to.
Okay, let's jump in. Where do we start?
Let's start with index funds. Our sources rate this one pretty low on the risk scale, like a 3 out of 10.
Okay, a 3 sounds relatively safe. What's the core idea?
Well, the basic concept is you're investing in the long-term success of the whole market, not just betting on one single company. Think of it like a horse race.
Okay.
Instead of putting all your cash on one horse, you spread it across, all the top runners. If one or two have a bad day, you're still in the game with the others.
Makes sense. Diversification. But what about the returns? Is it just slow and steady?
It can be steady, yes,
Yeah.
but the power comes from compounding over time. It's actually quite amazing. The source gives this example, investing just $5 every single day.
$5 a day. Okay, like a fancy coffee.
Exactly. That's about $150 a month, right? Into an S&P 500 index fund, assuming an average return of, say, 8% over 45 years.
45 years is a long time, but okay.
It is, but listen to this. That could potentially grow to around $791,000.
Wow. From $5 a day.
Yeah, break it down. And basically every $5 you invested could turn into maybe $48. It really makes you think twice about those small daily purchases, doesn't it?
It absolutely does. Though I have to say, sometimes that morning coffee feels like a necessary investment in just getting through the day.
Yeah.
But you mentioned downturns. Why do index funds become more appealing during a recession, according to the source?
Well, it's mainly because you're not relying on any single company to survive the storm. You're betting on the overall market, which, historically always recovers eventually.
Yeah, that makes sense. Less individual company risk.
And what's really striking, actually, is how this stacks up against, the pros. Get this. Over a 15-year period, something like 92% of top hedge funds.
92%.
Yeah, 92% failed to beat the S&P 500 index.
That's incredible. All that expertise, those fees. And they can't beat a simple index fund most of the time.
It's a pretty profound statistic, isn't it? It really suggests that sometimes complexity doesn't actually lead to better results. Simple can be really effective.
That's a huge takeaway.
Yeah.
And for anyone thinking the S&P 500 is purely U.S. focused.
Good point.
Yeah.
It's actually more global than many people realize. The source mentioned that back in 2017, almost 71% of its revenue came from outside the U.S.
Huh. You know, is that high?
Yeah. And of course, there are other index funds too, ones that focus specifically on global markets or emerging markets if you want even broader diversification.
So how did the source apply this with their $1,000?
They split it, put $750 into an S&P 500 fund, and the remaining $250 into a global index fund. The key strategy mentioned was just consistently buying, dollar cost averaging, regardless of market ups and downs, long-term focus.
Okay. Consistent, diversified, long-term. Got it. So moving from that kind of passive approach, let's talk about something more hands-on, starting your own business.
Right. This one gets a slightly higher risk rating, maybe a 3.5 out of 10. You could lose your initial investment, sure.
But the control is totally yours.
Exactly. You're in the driver's seat. And there's some compelling data here. Fidelity Investments found that something like 88% of millionaires are actually self-made entrepreneurs.
88%. Wow. That's a huge number.
It is. And interestingly, a recession can actually be a surprisingly good time to start.
Really? That sounds counterintuitive. Less money around, people cutting back?
Well, think about it. You might be starting lean, maybe from home, minimal staff, low overhead. This lets you offer potentially cheaper solutions right when customers are looking to cut costs. You can swoop in.
Okay. Finding the opportunity in the downturn. Does history back this up?
Absolutely. Look at the periods after major downturns post-World War II, the energy crisis in the 70s, the Gulf War, the dot-com bust, even the Great Recession.
Yeah.
Each one was followed by a longer period of growth and prosperity. Recessions, while painful, are often relatively short compared to the expansions that follow. It's like a window opens.
So it's about seeing past the immediate difficulty. What's a common mistake people make here, according to the source?
A big one is undervaluing your own skills and potential. Putting money into assets you don't control while ignoring the power you have to generate income directly.
Can you give an example?
Yeah, the source mentions this person selling PDFs online, helping people pass state exams, making maybe $400 a month just through organic marketing, like word of mouth.
Okay. Decent side hustle.
Right. But imagine if they took just $200 a month and put it back into their own business, specifically into paid ads. The potential return and how fast it could come is likely way higher than putting that same $200 into the stock market at that moment.
It's like watering your own garden first.
Exactly. The source uses the analogy of starving a plant of water. You can't expect your own thing to grow if you don't invest in it. It really makes you think, doesn't it, about where we put our resources.
It definitely does. So how did the source apply this philosophy with their $1,000?
They invested it directly into their own existing venture, a podcast, actually. They bought new tech for editing.
Ah, investing in efficiency.
Precisely. To save time, which lets them produce episodes more regularly, like weekly, it's about improving their own engine.
Okay, interesting. From index funds and businesses to fine art, this feels like a shift. Our source gives this a 5 out of 10 risk rating. Art during a recession.
Yeah, it does sound a bit surprising, right? But the data is quite striking. Over the last 25 years or so, contemporary art investments apparently averaged about a 14% annual price appreciation.
14% annually.
That's what the source indicates, yeah. Which actually outperformed the S&P 500's average of about 9.5% during that same period.
Okay, that definitely challenges some assumptions. But surely, when the economy tanks, people stop buying expensive paintings. What happened during the Great Recession, for example?
You'd think so, but the art market showed surprising resilience. Global auction sales did dip slightly in 2008 compared to 2007, from about $32.9 billion down to $28 billion.
A dip, but not a collapse.
Exactly. And that $28 billion was still way higher than sales in 2005, which were around $17.2 billion. And get this, just 5 months after Lehman Brothers collapsed, a massive event.
Yeah.
Yves Saint Laurent's art collection sold for a record $408 million. And the art market overall recovered about 2 years faster than the S&P 500 did.
Wow. Okay. So historically, art has been mostly for the super wealthy, needing specialist knowledge. How is that changing?
Well, that's where companies like Masterworks, mentioned in the source, come in. They're trying to sort of democratize it.
How do they do that?
They use a lot of data analysis and research teams to try and identify artists whose work seems to have high momentum. Then they buy paintings and offer fractional ownership so you can buy a share of a painting, not an NFT, but an actual share.
Making it accessible to regular investors, not just millionaires.
That's the idea. It breaks down that huge barrier to entry.
And what's their strategy? How does the model work for investors?
Their plan is generally to hold the artwork for, say, 3 to 10 years. Then they sell it and distribute the profits, minus their fees, to the shareholders.
And their incentives.
That's a key point. They apparently only make money if the painting sells for a profit, so their success is tied to the investor's success.
Okay. And performance. Any track record mentioned?
The source notes that for paintings they've sold so far, and remembering past performance isn't a guarantee, they've delivered around 25% net returns over the last 4 years, and that includes navigating through COVID and recent inflation.
25% net return is impressive, even with the caveats. So the source put their $1,000
into a piece by an artist named Mark Bradford called Promised Land through Masterworks. It shows just how accessible this kind of investment has become, even with relatively small amounts.
All right. Art, business, index funds. Quite the range. Now let's pivot to something more traditional, but maybe riskier. Individual stocks.
Yep, this one gets a 7 out of 10 on the risk scale from our source. Definitely higher risk.
Why so high? I mean, picking stocks is classic investing, isn't it?
It is, and it offers you, like, total control over where your money goes. You could potentially beat the market, but the reality according to the source, is that something like 90% of people who try to pick individual stocks actually end up losing money.
90% lose money. Ouch. Those are tough odds.
Very tough. It's incredibly difficult to consistently pick winners. However, a down market, like in a recession, can present opportunities. You might find good companies selling at a discount.
Okay, so looking for bargains, what kind of companies should you look for during a downturn?
The advice is to focus on really well-managed companies. Look for ones with low debt, good cash flow, strong balance sheets, things that suggest they can weather the storm.
And you can find this info.
Yeah, a lot of this data is freely available on platforms like Yahoo Finance. You don't necessarily need expensive tools.
Good to know. Are there specific industries that tend to hold up better?
Well, healthcare is often cited. People generally can't postpone necessary medical spending, recession or not.
Right, essential spending.
Yeah.
Any other examples?
Historically, companies like Walmart have done well. People trade down to discount retailers. And maybe surprisingly, McDonald's often sees a boost. People seek out cheaper comfort food.
Comfort food in a crisis.
Yeah.
Makes a certain kind of sense. So how did our source play this with their $1,000 in individual stocks?
They put the full $1,000 into Apple.
Apple. Interesting. What was the reasoning?
The thinking was that people are really, really reluctant to give up their iPhones. They see them as essential. Plus, many people finance them over time through their phone plans.
Ah, so Apple keeps getting paid even if the customer's bank balance is low at that moment.
That seemed to be the logic, yeah. It's playing on brand loyalty and those sort of built-in payment structures.
Okay, that brings us to our fifth investment avenue, the one everyone's talking about, it seems, cryptocurrency.
Yep. And this one gets the highest risk rating so far from our source. An 8.5 out of 10. Highly volatile.
8.5, okay.
Yeah.
No surprise there. It's been a roller coaster.
Definitely. You know, crypto, especially Bitcoin, was maybe seen as just a fad initially. But as Bitcoin rallied and held ground, it started gaining more credibility, even among traditional finance folks.
And it's not just about the coins themselves, right? There's the underlying tech.
Exactly. When you dig into it, the potential of the technology blockchain is what gets a lot of people excited. The idea that it could genuinely disrupt huge industries, banking, law, cybersecurity, insurance, the list goes on.
So if someone's looking at crypto, where do they even start? It feels overwhelming.
Well, the source points to what they call the blue chip cryptos. Much like blue chip stocks, these are seen as the most established or dominant players.
Yeah, those do.
Primarily Bitcoin and Ethereum. They have the largest market capitalizations by far. They're generally considered the maybe the safest entry points in a very risky asset class.
Safest being a relative term here, obviously.
Absolutely. Very relative. And right now, with recessionary fears and interest rate hikes, crypto prices have fallen dramatically across the board.
Which some people see as
A potential buying opportunity, a chance to get in at lower prices. But, and this is crucial given the high risk, crypto should really only be a small slice of a well-diversified portfolio. It's not something you bet the farm on.
right. Diversification is key, especially here. So the source is $1,000 in crypto.
They split it evenly. $500 into Bitcoin, $500 into Ethereum, spreading the crypto bet across the two biggest players.
Okay, so that covers the 5 main investment paths. But you mentioned a 6th category,
Uh-huh.
a contrast.
Yes. And this one isn't really an investment at all, which is the point. It's online gambling.
Ah, and the risk rating.
A full 10 out of 10, maximum risk.
Because it's not investing, it's, well, gambling.
Precisely. And the source shared a really telling anecdote. They actually took $1,000 and tried online gambling. On the first go, they won $4,000.
Oh, okay, I could see how that would feel amazing, like you cracked the code.
Exactly. That instant hit, that feeling of quick, easy riches, it's incredibly seductive.
There's always a but with gambling stories.
There usually is.
Yeah.
Immediately after that win, they did another $1,000 spin.
Lost a significant chunk. It just vanished. It perfectly illustrates how unpredictable it is and how the odds are fundamentally stacked against you.
Right. The classic saying, the house always wins.
That's the core lesson here. Over the long term, gambling is designed for you to lose. It's fundamentally different from strategic investing, where despite risks, the odds can be tilted in your favor over time through research and diversification.
And that initial big win can be dangerous psychologically too, right?
Hugely dangerous. It can suck you in, make you chase that feeling, that high again and again, which usually just leads to more losses down the line. It's a behavioral trap.
Okay, so a very stark contrast to the other approaches we discussed, a clear warning.
Definitely a warning.
So wrapping this all up, we've covered a lot of ground. From the slow burn potential of index funds to the hands on approach of business, the surprise resilience of art, the high stakes game of stock picking, and the wild ride of crypto. Plus, that stark warning about gambling. It's a really diverse toolkit we've unpacked. And being informed about these different options, their risks, their potential rewards, that's powerful knowledge for you, the listener, especially when the economic climate feels uncertain.
Absolutely. It's about giving you the information to make choices that feel right for you.
Indeed. It's all about empowering you to navigate whatever the future holds with a bit more confidence.
So maybe a final thought for everyone listening to ponder. We've seen strategies with very different risk levels, different levels of controlled passive index funds versus actively running a business, for example.
Yeah, a real spectrum.
So the question to leave you with is, what mix of these approaches, that balance between hands-on control and hands-off passive growth, might best align with your personal financial goals, your comfort level with risk as you build your wealth for the future?
That's a great question to reflect on. Finding that personal balance is key.